And we are live 3 minutes late. Sorry, everyone who's waiting. Thanks so much for joining us in today's video. I thought I'd make this a live video today because there's so many things going on in our housing market right now.
Sorry, everyone who's waiting. Thanks so much for joining us in today's
I'm
video.
hearing a feedback. Are you hearing that?
Live video today because
yeah,
we're going on our housing market right now.
Do you have YouTube closed?
I'm hearing a feedback. Are you hearing that? Live video today because we're going on our housing market right now.
I don't think it's on
Just
my
a second.
side.
Technical difficulties. Not
okay. That was my fault. Yeah, I had a background window open.
Last time I invited this guy on the channel.
Well, yeah, you know what? I'm a subscriber. I've got notifications set, so whenever you go live, I'm streaming it, man.
It just automatically plays.
Yeah. A lot of stuff happening in the real estate mortgage market, so I got to stay updated. I got to stay subscribed to Jason Walter. My fault. That was me.
Oh yeah, that's so funny. Anyways, yeah, thanks for joining, everyone. Sorry for the technical difficulties there. Hey, this is live. This is what happens, right?
Exactly.
But yeah, Matt, thanks for joining us on today's video here, and that'd be a good opportunity to kind of talk about the mortgage market. So you're the expert regarding that. I talk a lot about mortgage rates and the Fed and all that stuff, but you're definitely the expert in that regard. And so I thought it'd be good to talk about what's going on right now with mortgage rates, what's expected, what Jerome Powell talked about the other day. And also talking about in general the housing market, and of course answering your questions. And so we're only going to be live for 1 hour, so we're 4 minutes late here. Sorry, but until 3 p.m. is when we're going to be shutting this down. So Matt, thank you so much. Thank you so much for your time. And if you could just introduce yourself for those who don't know who you are.
Sure. Yeah. Matt, the mortgage guy. I've got my own channel on YouTube where I'm sharing mortgage education, what I see going on in the market, talking to agents every day, talking to clients every day in a market like our current one, where things are changing rapidly, right? And people are trying to pay attention to real estate and inventory and where mortgage rates are going and affordability and all that stuff. I feel like there's no shortage of information that the public is hungry for. What I generally try to do is keep it really simple and open the door, conversations like me and you might have as a realtor and as a loan officer. Just do that public in front of the average consumer so they can educate themselves and make decisions for their own housing needs. So check out Matt the Mortgage Guy on YouTube. Quick plug for that. I'd love to chat about mortgage rates. And I think, to properly set that up, me and you have talked about it offline where people think that, the Fed meets every, 6 weeks or, their set meetings during the year. And then they up the Fed funds rate by 0.75 basis points. And then that immediately translates to a mortgage interest rate. That's not how it works. The Fed does set the Fed funds rate and monetary policy, and that has an effect on mortgage rates, but it's not just like they're going in there saying, you know what, for this month, mortgage rates are going to be 6.25. So with all that being said, Jerome Powell and what he says, and what the Fed says as a whole really affects mortgage rates. Mortgage rates change on a daily basis. You do a good job of informing people, and you've got 5.96, which me and you both will just look to Mortgage News Daily for an average on mortgage rates. That tomorrow.
Okay, just updated that 2 minutes ago. It's a 5.99%. They always do like that teaser. It's here it is, and they update it. So actually, I had to scramble and revise my thumbnail before we went live. So that's part of the reason why we're late.
Anyway. Well, I can tell you, being on the inside, we've had multiple reprices for the worst today. So tomorrow, when that number comes out on Mortgage News Daily, I guarantee you it has a 6 in front of it. Whether that's 6.04 or 6.08. Mortgage rates are on the rise. And so, to get more into the weeds on why mortgage interest rates are on the rise, Jerome Powell at this latest meeting where he talked for 8 minutes, this, economic symposium in Jackson Hole, basically was very, very clear for the first time. And a lot of people are calling it the first time it's clear. We are going to keep at it until we are confident the job is done. And we're talking about keeping at it, raising interest rates, taming inflation, quelling demand. And he just said it straight up. Like, these are the unfortunate costs of reducing inflation, but like he needs to regain price stability. And so at the cost of higher interest rates for, mortgages, for businesses, for everything. Like, that's what the Fed plans to do. So when he comes out and says that, that's an immediate mortgage-backed securities go up, mortgage interest rates go up. We don't have to wait until September 21st when they meet and they go, oh yeah, we're going to raise the Fed funds rate by 0.75. That stuff is affected today. And so, he was stronger than he's ever been as far as like how he talked about what their plans were. Like no time soon are they going to pivot back. They're going to push interest rates up for some time was his words. So like all these things that people pulled out and wrote articles about is pointing to the Fed is like serious about taming inflation at all costs. And at all costs means mortgage rates are going up, rates on, car loans, student loans,
credit cards,
banks lending to each other, businesses and their debt, all of it is going to get more expensive. And that is going to tame inflation. And so there's a lot of people that are pointing towards, rates are going to reach 7%. Rates are going to reach 7.5% by Q4 of 2022, by Q1 of 2023. I'm not sure that they go that high, but they certainly could. And so it's just another piece of the puzzle, right? When you're talking to people who are in the market to buy real estate, whether it's where they're going to live or an investment property, these are the things they're paying attention to. And
one thing I want to touch on that is that you say that some people are 7%. I mean, really, it's like anyone's guess. And so I think like the take-home message that we should be telling people here too is that I was telling Matt offline is that I get a lot of comments about going saying that, oh, the Fed's going to be increasing rates by 75 basis points in September, and then just look out mortgage rates then. But if you look at the street's estimates, the street is basically expecting the Fed to increase rates by 75 basis points. I mean, look at what happened last rate hike. That was 75 basis points. That was what was expected, right? If I'm not mistaken. And so after the Fed raised rates, mortgage rates actually came down. And that's one of the reasons is because the street was expecting it. If the Fed had pivoted and done a 100 basis point rate hike, that could have caused a lot of volatility in the mortgage market. And so I think it's an important message to tell people is that the current rates we have right now are based on the estimated forecast that the Fed's going to be increasing the federal funds rate in the next coming sessions here. So if the Fed increases the rate by 75 basis points in September, that's expected. So I would imagine you're the mortgage expert, but I would imagine that a lot of people or the mortgage rates are basically going to, Real Smith, thank you for that. Thank you for the donation. I would imagine that a lot of people that mortgage rates would basically would be flat or plateau or even go down because that's what's expected.
Right.
If the Fed pivots and does a 100 basis point rate hike or more than that, that's what causes these big increases and big changes in mortgage rates on the upward trajectory. So correct me if I'm wrong regarding that.
No, you're exactly right in that like the rates that we see today are based on all the information we have up till today. And if we expect a 75 basis point rate hike on September 21st when the Fed meets, if they do 75, nothing should change. If for whatever reason, Jerome Powell and the Fed meets and they say, listen, due to what's going on in the economy, like we don't know if the economy can handle 75 basis points, we've got a new plan. I'm going to go 50 this meeting, 50 the next, and what they say and when they change, that's what causes the rate to change on that day. So when that 75 basis points is expected. It's baked in. The reason why rates got a lot worse literally these last 3 days is because last Friday, Jerome Powell, came out and made all these comments about what their future plans are. And so now, their future plans of raising the Fed funds rate to, I think they talked about going up into the fours, like 4% or higher. Currently it's 2.25 to 2.5. We expect 75 basis points in September. We expect probably another 75 or a 50 in the meeting after that. So over the next 3 meetings that the Fed has, they're going to raise that above 4%. That's all baked into the rate we see today. If that plan changes and they say, we got to go above 5%, we got to hammer down because inflation's not slowing down as fast as we thought, rates will get worse. If they say, you know what, we can slow this down a little bit. We only got to do 50 this next meeting, and the one after that we'll reassess. Those are the kind of comments that make rates get better. And so, exactly to your point, like we've already got that quote unquote baked into today's rate.
Yeah, I mean, well said. And again, thanks to Real Estate Mindset for the nice words there and the donation. But yeah, absolutely. I think that's a common misnomer that people believe that, if the Fed's going to be increasing rates, then that's going to cause mortgage rates to increase right when they do it. But current rates and the 10-year Treasury has already baked in the fact that the Fed's going to be increasing rates further in the months to come here. So that's a very important thing. I think I definitely wanted to talk about in today's video here. But other than that, what else are you seeing in the mortgage market that we should be aware of? Then we'll kind of get to some questions here. We have, 230 people already joining already. So thanks everyone who's joining us today.
Yeah, for sure. It's cool to have this open discussion and then fire off some questions. As far as what I'm seeing, had an interesting conversation this morning around, like, everybody wanted to find the point where demand truly was quelled, where people would back out of home buying. And anybody who's paying attention know that mortgage demand, the latest headlines we saw within the last couple of months is at a 22-year low. A lot less people are applying and buying. And it's interesting to see that rates went from 3 to 4 and you didn't really see a huge slowdown in demand. 4 to 5, still, people were buying. When we got to 6%, was it really like the brakes went on? And had an interesting conversation this morning is like, if demand is really quelled at 6% and, housing transactions are down 30 to 40%, what the heck is going to happen if we go to 7%? And, I'm one of the realists that knows it's going to slow even harder. And somebody who's entry-level buyer in a market like one that me and Jason work in, they might only be putting 3 or 5% down on their first home and paying $500,000. At 6%, that's a payment that's $3,600 a month, all in with taxes, insurance, and mortgage insurance. If we go to 7% and they're approaching a $4,000 mortgage payment, that's just, there's an affordability issue. And so it'll be interesting.
Yeah.
You're right. It'll be interesting to see because Jay Powell's come out and said it, like, we need a reset. We need this. But I don't know, how fast that happens. Obviously, we've seen in a market like Sacramento that have 30, 40% home price appreciation in 2 years. When we go from that to flat, where, I truly see we're going to see very little appreciation, maybe a little bit of depreciation over the next 12 months. That is a sharp right turn for people. And it feels a lot different because it is.
Yeah, absolutely. The velocity has definitely changed. Even if we're seeing, I think what Redfin's latest data shows that home prices are up, I think it was 3.6%, something like that, year over year. And so on a historical speaking, that's like average, normal, but just a few months ago it was 14%. And so this trajectory, or this big change we've been seeing over the past few months, is pretty eye-opening. I actually just made a video today that it was for second quarter according to the California Association of Realtors. So only 16% of California's households can afford to buy the median price home as of the second quarter of this year.
Wow.
So, but that's based on rates at 5.3%. So like you said, rates right now are at 6%. What if they get to 7%? Then housing affordability is absolutely going to tank because it basically went down from 24% in the first quarter down to 16% in the second quarter. So a huge amount of changes we've been seeing in a short period of time, which is pretty astonishing. Let's get to some questions here.
Yeah, fire off some questions.
Yeah. Let's see. All right. So we have Dad. With what you're seeing and in your opinion, if you had to take a stance on the housing market, will this end up being a clear clash or more like a correction? In my opinion, it's going to be more of like a correction. So that's based on the data we have right now and the projections for mortgage rates and such. And so what we're seeing right now is kind of interesting dynamic. The past few months, we've been seeing this huge uptick in inventory. A lot of houses being not listed for sale, but inventory increasing. And the new listings have basically been on par with the past few years. But as I mentioned in my previous video, it was Realtor.com, a data that I looked at. You look at the actual changes in price reductions and also the increase of inventory, we're seeing a slowing effect. And that's because new listings have been going down greatly over the past several weeks now. And so if you think of inventory as a bathtub, new listings going in, fill up that bathtub with water. The water is housing supply. If you want to drain the water in the bathtub, you have more contracts being signed. So what we're seeing right now is new listings not going in the bathtub as much. And so because of that, that's causing a softening of inventory. And so if that continues, that's really going to soften any correction that we have. We already have a downturn right now. So in my opinion, if we continue to see a lack of people who decide to sell their houses, then that's going to soften the impacts of a correction. However, if we go into like a clear recession where a lot of people are losing their jobs, then that's a different story. I think that's kind of like the last piece we should be looking at is, number of people have jobs. If they lose their jobs, that could potentially increase the number of people listing their houses for sale, foreclosures, and whatnot. So anyways, that's a long-winded answer to your question there, Dad. But what do you think of that?
Yeah, I mean, I see more of a correction. And if I were to peg it, as far as like what I see 2023 home price appreciation being, I think that it's somewhere between 0, which is no home price appreciation, and negative 5%. All the talk of home prices going down 30 or 40%, boy, oh boy, like as an investor, I would love to see, drastic, cuts on prices. So I could pick this stuff up at a discount. But to your point, although we've got the plug of the bathtub stopped because demand has really slowed down, we don't have enough flow going in to overflow the bathtub, which is going to cause home prices to come down. There's just not a lot of new listings coming on the market. There's no panic selling. There's no foreclosures. There's not all these things that we would need. A glut of supply would be needed for us to see a big correction, 20%, 30%. And I just don't see it. Like you look at 2022 numbers versus 2019 or pre-pandemic, and the listings coming on market are less than they were back then. The only reason we have more inventory is because things are selling a lot slower, and that's a demand problem. So like we really see the shortage on both sides, a shortage of demand and a shortage of supply, where that balance or imbalance is what's going to cause home prices to go up like crazy when there was a ton of demand and not enough houses. That's when we saw the huge ramp up in prices. In order for it to go the other way, we would need a ton of supply with the very little demand we have. There's just nothing that's going to turn that supply lever on full max, which would be needed for a big correction, in my opinion.
Yeah, I agree with you, because if in our marketplace right now, we basically have new listings going down. On Redfin right now, they have new listings down 15.4% compared to 2021 and below 2019's levels as well. If we were in a market, and you're right, because we're seeing this increase of inventory, that's really due to a lack of contracts being signed, a decrease in demand. If we were in an environment where we're seeing new listings shooting up every single week and beyond levels of the past few years, that's a recipe for disaster there. But we're seeing just the opposite. We're seeing new listings actually coming down because people at this point don't need to sell. If they don't get their price, they can just take their house off the market. They have tons of equity in their house already. And so there's really there's really no data point that's really showing how like there is going to be like this housing market crash. Unfortunately, times will change. Things will change based on data that changes. But based on what we see right now, I really don't see it. To that point, Kevin, hey, a longtime subscriber. Good to see you here. Thanks for joining. And Lencia has a question. I think this is more of like a question for you, Matt. I haven't heard of the equity loan builder forgivable loan. Do you know what she's referring to regarding that?
Yeah, it's actually a Cal HFA program.
Oh, okay.
That's pretty cool if you fit into that relatively small bucket that qualifies. You got to be under the area median income. I think it's about 81,000-ish in California. But then still have enough.
Cal HFA program?
Yeah. And it's really a neat program. They give you up to 10% of the purchase price over the first 5 years. It gets forgiven 20% per year. So if you stay in the home as your owner occupied for 5 years, you're going to get that thing 100% forgiven. The issue with it is the qualifying piece, because you have to make enough to qualify, but then you can't make too much, which disqualifies you. And, in California, like a lot of us know, if you're staying under those income limits to qualify for the program, but your max purchase price is $360 based on what you make, you're going to, have a small amount of housing and areas that you can actually shop in.
Okay. Thanks for your answer on that, because I haven't heard that program before. All right. Let's get some other questions here as well. Thanks everyone for joining.
Just real quick on that one too. When do new down payment assistance programs get released? I think more of these are coming. I literally just saw something this morning a webinar that's going to happen tomorrow. Equity Prime Mortgage out in Georgia is going to release what I believe to be a nationwide product with down payment assistance. My only warning to folks is, I know down payment can be a hurdle for home buying, but you need to make sure everything else is in alignment as far as like ready to purchase a home. If it's hard to rub together two nickels, you don't want to necessarily go out there and tie yourself to a $2,700 a month mortgage payment. If it's going to be a struggle to make the payments, I want you to be ready before you buy a house. I want to be part of the dream. I don't want to be part of something that turns into a weight, stress, and a nightmare.
Yeah, that's why I tell people don't buy unless you have long-term time horizons of 7 to 10 plus years. Of course, I've been saying that for like 10 years now. In hindsight, gosh, if I said that, if someone bought 2 years ago, they're doing really well. But
right, they're like, what do you mean, Jason?
That's a conservative route.
I went up 40% in 2 years. It's easy.
Yeah, I know, right? Hindsight's 2020, but that's like a general rule of thumb that people should really follow. If you bought a year ago, you're pretty lucky right now, especially if you bought a house in Boise. So Jared has a question for you, Matt.
If you buy someone's house subject to the existing mortgage, is there a way to make sure the lender doesn't call the mortgage due in full? What's my buddy's name? Ryan Nickel. Does a lot of subject to in California. I'd probably defer to him. He's probably got, I think he's got a YouTube channel, Bootstrap Investor or Bootstrap something. I know a lot of investors that do it all the time and don't get the mortgages called due. It's similar to when people are like, hey man, if I buy this house and I put it in the name of my LLC, I'm afraid they're going to call the mortgage due. If you get a mortgage and continue to make your payments, like I just never hear of mortgages being called by a lender. So, I don't want to pretend that I'm sure of it and that like you've got no risk at all. Go ahead and do it. But I haven't heard of notes being called due. So I would guess that, you're probably safe.
Okay. Good to know. I know nothing about that. That's why it's great to have you on the channel here to talk about to answer the mortgage and loan questions here. Really. Here's another one for you too. It's from Real Estate Mindset. Thanks for your question. Do you think the doubling asset selling by the Fed that starts in September of $95 billion will impact the mortgage rates? Good question.
Yeah, I mean, as they run off their balance sheet and start to sell off mortgage-backed securities and treasuries, like no doubt that has upward pressure on mortgage rates. And this is probably the reason why folks are saying we could see a 7 handle, we could see an 8 handle on mortgage rates. Everything the Fed is doing is applying upward pressure to mortgage rates, and the selling off of their balance sheet. They were buying mortgage-backed securities; they were the biggest buyer, and they're buying treasuries. Now they're pivoting and selling that stuff as they bought. That had downward pressure on rates, and that's how they were able to stimulate the economy and take rates down to 2.5% on a 30-year fixed. When they start to sell that stuff off, it has the opposite effect. So for sure, it has impact on interest rates in the upward direction, which people don't want to hear, but that's the truth of the matter.
Yep, it's definitely true. J Homeboy, a question: what's your thought on the new development in D.R. Horton in Napa County, beginning pre-sales November 22nd? Where do you think they'll start? Oh, geez, I have no idea about this. Where do you think they'll start prices? Lower in case of the trend? Yeah, I have no idea. I know like basically like this much regarding Napa, let alone a new development there. Sorry. This would be a question for their sales department. If they don't have prices yet, they probably don't have their master plan approved by the county, I'm guessing. So I would just wait to see what their prices are going to be. One word of caution though, like I mentioned in previous videos though, if you put a deposit down on a dirt lot, oftentimes you can't lock in your mortgage rate until months down the road. There are some programs out there where you can pay a premium to lock in your rates. Some builders are paying to buyers to do that. But in my opinion, it's pretty risky to put a deposit down on a dirt lot in which the house is not going to be built for 12 months later, because you don't know what your housing payment is going to be like, let alone the economy, the housing market, et cetera. So hope that answers your question in a roundabout way.
Yeah, that's a good one. I should hammer home for you, Jason, is don't buy something with a far enough out completion date that you get caught like some of these people that were 3% interest rate in January. And, I'm talking to them now because they're like, it's going to be done in November. I'm going to back out. And they're asking me Should I back out? What would you do if you were me? I've given a lot of people advice where I say, listen, luckily for you, you've only got 12,000 non-refundable, or lucky for you, you've only got 15,000. But, I talked to a guy who's buying out in Texas, and his projected payment of $2,600 has turned into $3,500. And he's just like, that's going to stretch me. And I still qualify, but that payment makes me uncomfortable. And I said, the fact that you're not even in the house yet and you're already uncomfortable tells me all I need to hear. Like this, you cut your losses, take that $12,000 earnest money and just, chalk it up as a lesson, but don't sign 30 years at $3,500 if you know it's going to stretch you and stress you out. So this question for Jay Homeboy, I swear I'm having like flashbacks. I think this same question came, I don't know if it's the same person, but about new builds in Napa County when I was talking to our buddy Jeb Smith last week. And it's Jason's guess or my guess or Jeb's guess as good as anybody else's. A new home builder, like a seller, is subject to set their price, wherever they want based on, their specific strategy for, how fast they want to sell, or if they want to, set phase one at a certain price and then up it from there. Good question, but it's hard to really pinpoint what we think it's going to be.
Yeah, interesting thing about the deposits, like you mentioned, a lot of deposits are pretty low, like around $10,000 for an existing house in Sacramento. The standard deposit amount is like 1% to 2% of the purchase price. So it's a $500,000 house. It's very common for the deposit to be $5,000 to like $10,000. There's no like, this is set in stone, but that's kind of like the average. Toll Brothers, on the other hand, they have a development here in Folsom. I think in general, as a company, their deposits are extremely high. Actually, was reading through their earnings call transcript because they just announced their latest earnings for the quarter for their company. And they're seeing how their cancellation rate was very, very low. I mean, way below the industry standards. And that's because on average, their deposits, if I'm not mistaken, it was like $50,000 to like $90,000, something crazy.
Wow.
So, but their average price point is like over $900,000, but still, over $10,000 or $20,000 is still a very, very high number. And so their strategy appears to be, get a very high deposit amount, really lock in people, because how many people are going to be backing out of buying a brand new home if they have $70,000 as a deposit with a builder, right? So that's kind of one interesting builder who has a really high deposit amount, which is far higher than resale deposits that we typically see here. So interesting strategy they're using. I wonder if that's going to work in the months to come, given the fact that demand has been decreasing, though.
Right. Yeah, I would say with the tone of builders and how it's changed quite a bit, I think they're going to have a hard time getting someone to plunk down $50,000 as a deposit, because it's a risk, right? Like if I'm a home buyer in today's market, I don't like the feeling of putting down a deposit, especially if it's the farther out the completion date, the more risk you're at. Rates might be 7.5 next February.
Yeah. I talk about how the new home sales have been decreasing quite a bit. And then cancellations have been increasing as well. We've seen a pullback in construction as well. And I'm actually going on Instagram the other day and I see an ad from a builder. And I saw that ad like a few times. And then I was on the internet about a couple of weeks ago, and I kept on seeing an ad, those ads that kind of follow you around. I kept on seeing the same ad from a builder here in the greater Sacramento area as well. And like, 1 year ago, even like in January, you would never see that because they didn't need to advertise because they had such high demand. Anyways, Patricia has a really good question here regarding mortgage lenders as well. Matt, you want to take away that one as well?
Sure. Yeah. Thanks for the question, Patricia. Will mortgage lenders start offering more aggressive incentives like covering closing costs and offering lower points for refinancing? Refinance volume is down a ton, like 86%.
Yeah, like 85% or like. I just made a video about that today. Yeah.
Yeah, I think the latest numbers were like 86%. It's crazy. I looked at Fannie Mae's projections for refinance volume, and I got it on my computer. 132 billion for Q1 of 2023, which sounds like a lot. And then you look back at Q1 of 2021, and that number was 871 billion. So refinance volume down a ton. And it's easy to understand, right? It's because rates went from 2.5 on a 30-year fix to mid fives, and pretty soon at some lenders, depending on credit score and loan to value and all the other things, we're coming up into the sixes. For this specific question, Patricia, lenders are going to be more aggressive in that they're going to set thinner margins because they have to compete for business, because mortgage business as a whole, we're going from record-breaking 4.4 trillion in originations to 2.4 trillion, and in 2023, probably closer to 2 trillion. So as mortgage volume as a whole slows down, lenders get more competitive, but they can't necessarily offer, a 4% interest rate, right? They're just not going to make any money. But between lenders, you're going to see competition to where they used to make a bigger spread, and they could, charge you an interest rate that might be 0.25 higher than the market, and people would still do business with them. As they get competitive, you're going to see, more competitive rates, but that competitive rate today might be 5.5%. And if they had the margins that they had last year or the year before, that would be 5.875. So to the consumer, it might not feel like it's really aggressive and it's a great deal, but in terms of margin going back to the lender, it is. It's always going to be the case too, where you're talking about covering closing costs and lower points. You can slide. If you came to me today and said you can slide up and down the rate scale, and you said, I want to do a refinance, what rate am I going to get? I'm going to say, you pick. You want the 4.99 that cost you 3 points, or do you want 6.5 where you get a lender credit of 1 point? And somewhere on that scale, you're going to find what works best for you. The 6.5 provides you some credit where you don't pay closing costs. The 4.99, you pay closing costs and you pay a couple points to get it down. So it's not.
I think a lot of people aren't aware of that, because you can get like what the rate on par with, you're not paying any points. But if you pay points, you can get a lower rate. If you get a credit, your rates can be higher. So that's what Matt's referring to there.
Yeah.
Sorry.
If I got too granular there, I apologize. I try to keep it fairly simple, but it's like, it's one of those things where there's 1,000 different inputs, on credit score, loan to value. If I'm doing a cash out refinance, if I'm doing a rate and term, if I'm doing a purchase, if I'm, buying an investment property, I'm buying a second home, I'm buying a primary, all those things combined, you're going to have a whole rate sheet with a bunch of rates to choose from. Some are going to be more expensive than others, and then some are going to even provide a credit. So for your specific scenario, talk to a lender you like and trust. Make sure that you're able to talk to somebody who dials in on your specific scenario.
Good answer. And then here's another one for you too. Where can I show this? Oh, we're getting buggy here.
Could be.
Sort of like, huh? Let's see. I'm trying to show a comment, but it's not allowing me, guys. Okay. I'm really. For anyone knows, I'm on StreamYard. You click on show when you see a comment.
We lost Jason. I think his internet was going bad. I wonder if I can show comments. Probably not. I probably don't have access. No, just him. He's got some starred comments on there. So hopefully we get Jason back. I'm glad to know it wasn't my internet that was having issues, but some of the starred comments that it looks like Jason might have started. He's back. Don't worry, man. I kept the show going.
Technology.
I know. Technology is hard.
Yeah.
I was trying to see.
Now it works. Finally.
There we go. Yeah.
That's what happens when you have a live stream. It's like if during my videos, I screw up like 20 times in a row, but you only see like the edited version. So it seems like I know what I'm talking about, and I talk very well, but I don't. Anyways, yeah, this is the challenges with a live stream here. Things happen. I don't know what happened. Anyways, this person has a question. Do you really believe that the Fed is going to sell assets in September? I really have not. I have no knowledge regarding this whatsoever. I know the Fed has plans, and sometimes they don't necessarily follow through. So what's your thoughts regarding that, if you have an opinion regarding that, Matt?
Yeah, I mean, I think that this stuff changes so often, right? Like if you would ask me a week ago about Jerome Powell and the Fed and their future plans, I would have a totally different answer. And he comes out last Friday, guns a-blazing, talking about fighting inflation, price stability at all, whatever it takes, right? And so it's certainly a possibility, but I guess we'll wait and see. Like anything else, like I'm probably going to spend the majority of my day serving clients and writing mortgages and advising where I can, versus like trying to guess whether they're going to do more quantitative tightening and they're going to go from 47 billion to 95 billion a month in selling. But I'd probably say the chances are, if you were to bet one side or another, they probably will. Like the quantitative tightening, especially like Jerome Powell's talk from last Friday, it's the plan. Like the Fed understands that it's a necessary evil to fight inflation, and they're saying that like it's going to be painful. It's likely going to impact the economy, but it's better to rip off the Band-Aid, take the pain now, than to not do it and have inflation run rampant for longer.
I hear you. I mean, the first thing that came to mind when I read the comments from Powell saying he's going to have to bring the pain to households, I was thinking like, I'm going to believe it when I see it. So I think that's what this viewer here is kind of alluding to as well, is that that's their plan, but we'll have to see if this actually comes to fruition here. Here's a good question here about mortgage lenders. Is it true that mortgage lenders are going out of business? What implications does this have for the housing market? So I think that a lot of the articles that have been surfacing over the past several months really are from, a lot of them have been like online lenders who really focus on doing refis. And because refis are down over 80%, or the applications are down 80% compared to 1 year ago, and because rates are up about 3 percentage points from a year ago, we had this fallout in refis. And so loan officers and lenders who have been focusing on their primary source of income or revenue from refis are obviously hurting. They're doing layoffs. So that's my opinion regarding that. That's a kind of simple answer, but what's your take on that regarding Tyler's question there?
Yeah, for sure. Mortgage lenders are going out of business, and to a certain extent, it's to be expected. Just like Purple Bricks and Really and some of these real estate companies that emerged when times are booming and everybody's making money, you can have inefficient businesses that operate in that type of environment that can't sustain or survive in a market that's tighter. When refinance is down 86%, and even the purchase volume is down because rates are higher and demand is down, like there's going to be less market share. The pie is going to be smaller. There's not going to be enough pie for some of these players. And so I think, as unfortunate as it is for the human beings that work for some of these companies, the companies that aren't so great are meant to go out of business. The great players and the great humans from those companies will go find other companies to go work at and win at. But there's going to be more of that because demand is down, the market is shrinking, and it even would trickle down to individual loan officers and individual real estate agents, the ones that were part-time doing a transaction a month and didn't run efficient business models. I think the latest stat I heard was 20 to 30% of originators won't be originators in 2023, which is unfortunate for that specific person, but it's a nature of the beast when there's less mortgages to be written.
Yeah, it's entirely true. I mean, for refis plus purchases going down greatly. Just made a video today regarding applications for loans for purchases are the lowest levels since November 2016 right now, if you exclude the onset of pandemic in April 2020. And so because of this pull out of demand, both for refis especially, but of course purchases as well, we're going to see real estate agents, loan officers, and lenders basically calling it quits or getting fired, really, sadly. But it's just the nature of the beast, unfortunately. When you have such a crazy housing market we've had for 2 years, and all these people had to hire all these people, more people in order to satisfy that business. Like Redfin said, we basically couldn't hire enough people. We had so much demand. And now they're saying, oh, we actually hired too many agents or too many people, and we don't have enough work for them. And so they did a layoff a few months ago. So that's what we're seeing in the market. But I'm not too sure how it's going to affect our housing market. It's really the effects of the housing market causing these people losing their jobs, really. All right. And Stacy, I think your subscriber count really went up a lot. I appreciate that. I actually have no idea how much it's gone up over the past few months, but I had like this I don't know. I was going to test the waters by posting more videos starting in April, and the growth has been like tremendous. And so I just keep on doing it. So, and there's so much more to talk about too. I mean, 2 years, it was like, okay, here's another video about record low inventory and home prices are at record highs.
Mortgage rates at 2.5%.
Yeah, and home buyers are screwed. I got sick of that, making those videos, or sick of looking at the data and feeling bad for home buyers as well. And now it's like, okay, wow, there's like so many changes going on. I can make like 4 videos a day and still have like more content to post. And so I'm really enjoying it. And for everyone who is watching, gosh, 400 people who is subscribed to my channel as well as Matt, then we appreciate you.
There's a lot to talk about. Yeah, you're right. Like housing and what's going on is so hot that, even the Meet Kevins and the Graham Steffens and the Patrick Bet Davids of the world are talking about real estate and housing.
Yeah, they're not talking about stocks as much. No, I'm just kidding. They talk about stocks quite a bit. Question: do you think it's a good time to buy another house now? I had just bought a house like a year ago, and it went up in value, and I wanted to take the value out and buy another house. Not knowing anything else, I would say no.
Yeah, that sounds like a bad plan. When people talk about take the value out, if you bought a house a year ago and you have a 2.75 30-year fixed and you owe $500 and the house is now worth $720, please leave that mortgage alone. The only person that's going to tell you to do a cash out refinance is an idiot who's working in a call center at Quicken Mortgage. I'm sorry that I had to be blunt about it, but like, no right-minded mortgage advisor that cares about you and your financial future is going to tell you to refinance that loan. And I think it's something that's important. And I want to, be really clear when I talk about this. Cash out refinance and home equity line of credit, both. And I'm a mortgage professional, so I make a living by writing mortgages. These are products that I offer. Right now, if you've got equity in your home, and you're looking for a way to extract it just for the sake of extracting it and going out and levering more, not a good idea, right? And as we start to run these numbers for people, we realize, yeah, you can pull out $100,000 in equity because you have it, but you're going to increase your monthly payment by $900. Don't do that, right? And then especially don't double down on that, levering up and adding debt by going to buy another house. There's investors and there's people that I work with that are able to, leverage and borrow money and do things like this. But for the vast majority of people, it's just not going to make sense when you really break down the numbers. Unfortunately, Jason, like I talked to some of the data folks at BlackRock who work in data analysis, and people are taking out cash out refinance. Rocket Mortgage is like far and away writing the most of these types of loans. Like it's not even close.
Cash out refinances right now?
Cash out refinances. And
I got a question regarding, I knew before you tell us, is there a source we can go to find out how many people have done cash out refis? I see, total refi originations, purchase originations on Black Knight, for example, but is there a source, and maybe you can, finish up your thought here, but is there a source that we can look at to see how many people actually are taking on HELOCs and doing cash out refis?
I don't
Sorry
know
to interrupt you, but
no, it's okay, because I don't know if there's a public source, because I have a standing meeting like every 2 weeks where I'm just talking to somebody who's working literally that's the job, prepay analyst, looking at prepays and trying to figure out like how fast people are going to prepay, why people are prepaying, and it breaks it down by lender, by credit score. And it's scary and quite honestly kind of pisses me off, when it's a 600 to 640 credit score and it's an average spread of like 300 basis points, meaning they went from 275 to 575 or 3.25 to 6.25. So doing that to somebody is really like hurting them long term. So I'll try to see if there's anything public I can find. I'll shoot it to you afterwards. But
Yeah,
for
please
now,
do.
I'm just relying on the conversations I'm having with
Yeah, I mean,
folks who are watching
it
that
seems
stuff.
to make sense that people are doing if someone's doing a cash out refi and they have a 3% mortgage rate and they're moving to a 6% mortgage rate, that really goes to show how desperate financially they are, or how dumb they are to buy a boat, for example, right? So it seems like it'd be people who really need the money who are doing that, and hopefully it's
Yeah,
not people who are going to be find something frivolous.
Right. Unfortunately, there's great salespeople out there that don't have integrity. That are just going to go out there and talk somebody into it for whatever reason. Oh, it's a blended rate. You're paying off high interest credit card debt. So like the 20% that you owe on that 22,000, please talk to somebody. Go to greatmortgagebroker.com. Fill out the form there. We'll give you good advice.
Awesome. And thank you, Stacy, for the donation. I really appreciate you. Appreciate you being a subscriber. And Johnny Fly, Folsom in the house. I was just in Folsom yesterday, actually. Folsom just like 15 minutes away from us.
People love them some Folsom. Good schools, good neighborhoods.
Folsom's awesome. I really like Folsom. Yeah. I used to be really into cycling. I loved biking around there back when I was in shape.
I used to run around Lake Matoma. I ran a marathon in 2021. This is a small sidebar, but 2021, Jason, I ran 882 miles because I was training for a marathon. I ran the CIM in December. I used to run around Lake Natoma. I had an office that backed up there. My office is now in Sacramento, but year to date in 2022, I've probably ran less than 30 miles. So did all my running last year, got it out of the way.
Well, my year-to-date running miles is 0. I used to be like a phenom. I did like 75 triathlons. I did it for like 10 years. And I used to do like, my average week would be like at 12 hours on a rest day. And I would do like 20 hours on like a normal week for like a working out. Yeah. It was like swim 3 times a week. I'd bike around 200 miles and I'd run like 20 to 30 miles a week. It was just insane.
Wow.
That was before kids, when I was a young buck, before I had these spray things in my hair. Anyways, all right. I don't know anything about Carlos's comment here. Good question. Is it more expensive to build a concrete or brick house in the U.S. compared to wood? So in the greater Sacramento area, we have basically all the construction is wood, as far as I know. I mean, I would say probably the vast majority is. I don't see any builder who's building houses with brick or concrete. That probably maybe due to the fact that we're fairly close to a couple of faults from the earthquakes. But anyways, yeah. Do you know the answer to Carlos's question?
I'm not
sorry, Carlos.
not an expert here, so yeah, sorry.
SAS67, hello, thanks for joining. RPG Archive, hey guys, how you doing? Thanks for joining. And yeah, thank you. You're very welcome. Appreciate that. Matt, a longtime subscriber. I see your comments on the channel. Thanks for joining today. Got laid off yesterday from a mid-sized bank. Many people have been laid off from our mortgage division from last week. I'm sorry to hear that. You're not asking for advice. I don't think you're asking for advice, but if you are a homeowner and you have a loan, you might want to contact your loan servicer about doing a mortgage loan forbearance program. Because if you have a loan that's backed by the federal government, you still can enter into an initial forbearance program. In other words, you can stop paying your mortgages for up to 12 months. So a lot of people don't know that's still available. And that's according to the Consumer Financial Protection Bureau's website.
Yeah, sorry to hear that.
Anything you want to add regarding that? Because I'm sure you probably do that a little bit more than I do.
Well, yeah, I mean, I to your point, yeah, a lot of people don't know that forbearance is still available. But sorry to hear about the layoff, Matthew.
Yeah, sorry, Matt.
Some of the banks are even getting out of mortgage origination altogether. It's a competitive space that's only going to get harder. And I think companies are
wow, really? So they're moving to like not lending at all, is what you're saying for in the mortgage industry?
I think I was talking to somebody. It was a big bank like Wells or Chase, might have been Wells, where they just said strategically they know that it's a shrinking market. And truth be told, a place like Wells Fargo knows they're not that good at it. I mean, they're not competitive. I should be nice, not that competitive. And so they're moving out of it. They're shutting down different offices across the country and moving out of mortgage origination. And so, if mortgage is your passion, there's always companies that are growing, U-Mortgage being one of them. They're looking for great people. So hopefully you land somewhere soon. I've seen a lot of people find success and, on LinkedIn and on these other places where, they're kind of posting, hey, a lot in my world, account executives from wholesale lenders lenders might not be going out of business, but they shut down their wholesale department. So all those account executives are now looking for new positions and, generally land, somewhere else. And, it might be one of those things where something bad turns into a great opportunity in a new direction.
Yeah, that's what happened to me, really. I didn't get laid off. I was in a contract position when I was a CPA a long time ago. And I was like sitting at home going, what the heck am I going to do? And then I had a buddy who was in real estate and went to an open house, like, oh, this is pretty cool. So I got my real estate license, and that just kind of changed my whole career path. And I'm so much happier doing, real estate, now YouTube, doing real estate and YouTube, really, compared to when I was a CPA. I mean, it's so much more fun.
You mean CPA isn't fun? Isn't not fun work doing accounting?
You're black now.
Oh,
that's what you get for that comment. I just blacked you out.
You know what I was going to say? Hopefully you can still hear me, right?
Well, I can still hear you. Yeah.
It's been such a crazy day as far as like mortgage news and everything that's happening that I've been like 9 o'clock, 10 o'clock, 11 o'clock, you at 2 o'clock. I've got a interview at 3:30 that my camera is worn out almost as much as I am. And I saw it too. I saw that the battery was running low, and I have it plugged in to where it should die. But we'll see.
Well, Grown Up Gaming, thanks so much for joining. A longtime subscriber. I noticed your comments as well, so appreciate you, and everyone else who's joining here as well. All right, can you see the screen, Matt? Or
I can see everything still. Battery exhausted.
It says battery exhausted.
Yeah. Come on.
It didn't say Matt the mortgage guy exhausted, so that's good.
You know what?
JM has a question. What's more likely? Sorry?
I'm going to try to find another battery. I'll be right back.
No worries. All right. So what's more likely? Home prices declining or lenders start? Let me just see if I can put. Let's just keep the way it is. What's more likely? Home prices declining or lenders start 40-year mortgages? I would say home prices declining. We're already seeing prices declining ever since July-ish. So past month or two-ish. Home prices have been going down on a national level. Every housing market's different, but we are seeing home prices declining, not by a whole lot just yet. So I definitely, we're already seeing that. Lenders starting to do 40-year mortgages. I certainly hope that doesn't happen because that would just increase demand.
I gotta chime in there too, since I'm in the mortgage space. Someone's going to tell you, 40-year mortgages are already here. Not really, right? 40-year mortgages are like a really niche product done in the non-QM world. As far as Fannie Mae and Freddie Mac adopting 40 years and it being like a product that's available at scale, it's just not coming. I've talked to the, biggest and baddest mortgage folks that are operating at the highest level, and they just told me, Matt, 40-year mortgage will not be a Fannie Freddie product ever.
Okay.
So with that being said, I would say I lean towards home prices declining first. To your point, we've seen some reductions, and I think as demand continues to fall, prices coming down shall follow. I'm trying to figure out if this battery wants to work for me or not.
It's all right.
This battery's exhausted.
Carlos says everyone's exhausted, even your battery.
Yeah.
That's too funny. Oh man, the Case-Shiller index. I used to make videos about Case-Shiller, and their data is so old when they release it. I mean, they just released. Oh my gosh, you got a QR code here. Let me see if I can just take you off here.
Yeah, maybe.
All right.
Uh-oh.
It looks like you're coming on. Yeah, the Case-Shiller index. I used to talk about that. They just announced June's numbers. Like, why would I make a video about June when it's the end of August? And so I don't really follow Case-Shiller. I don't know why the media talks about it all the time, but anyways, yeah, it's interesting. Prices
good for me. I bought me an extra battery pack.
Oh, there you go. Perfect. Well, we only have about 5 more minutes here. Let me see if there's any other channels or channels. Thanks for your answer. Love your channel. Oh, awesome. You're more than welcome. I just started some. Let me look at the questions here. I have a couple here. So yeah, I'm going to be ending this at about 3 p.m. So if you guys have any questions, please let us know. We have 420 people still on. Thank you so much for joining me in today's video. Short notice here as well. Haven't done a live stream in a while, but really appreciate you joining, Matt. But Brian has this question here. Up to how many points off interest rate can you buy, and who is the what is the average cost for it? Is it worthy? Can you include it in the loan?
Brian, this is a really good question.
Points.
And so, yeah, I'm gonna do my best to be clear, I know sometimes I speak too fast or too in the weeds. So this is
Speaking
a
of too
very,
fast, I always talk too fast. So you're not going to
yeah.
talk not faster than I do.
Well, so, but this is such a common question. It's such a good
Yeah.
question that I want to do it justice. So how many points off the interest rate can you buy? This is something that I think even new loan originators don't understand. In order to pass QM, be a qualified mortgage, you can't buy 6 points down on the interest rate. I might have a rate sheet, Jason, that goes down to 4% for somebody, but if it's charging 6 points, I can't do that loan. It won't make it through QC. So what I've seen to be the case is really you can't buy more than 3% down, Brian. I'm sorry, 3 points on an owner-occupied loan. On an investment loan, you might have some more flexibility. You might be able to pay 3.5 or 4 points to buy down the interest rate. Now let's talk about how much a point is. If you have, for example's sake, you're buying a $400,000 house and you're getting a $350,000 mortgage. You're putting $50,000 down. 1 point is equal to 1% of that loan amount. So 1 point on a $350,000 loan is $3,500. And just for example's sake, let's say that today's interest rate, like Jason mentioned, par, not paying any points, no cost to you as the borrower, is 5.75%. If I tell you, yeah, we can get you 5.375, and that's going to cost you 1 point. For that $350,000 loan, that's $3,500. You pay it up front. You can't roll it into the loan on conventional loans. Most loans, for that sake. There's some weird non-QM products where you can, but we won't go there. Now, if you say, I want to pay 2 points or 3 points, maybe 2 points gets you to 5.1. Maybe 3 points gets you down to 4.75% on a 30-year fixed. It's more common nowadays, especially because you might get a seller to credit you the $7,000 that you're going to spend with 2 points. Because remember, 2 points is 2% of that $350,000 loan amount. So it's $7,000. So hopefully that cleared it up. Is it worth it? Was your question as well. That's something that, speaking with a qualified loan officer who can walk you through a break-even analysis, is really important. Because we might look at it and say, at 5.75, your payment is $2,200 a month. If we buy it down to 5.375, that's going to save you $75 a month. If you buy it down to that next number, 5.1, that saves you $130. Whatever that per month savings is, you divide that by how much you're spending. And if you told me you're saving $75 a month and you paid $3,500 up front, I would do some quick math and say, that's a 46-month break even.
Yeah.
A break even of that long might not make a lot of sense. The other caveat, and anything to do with mortgage, there's so many different factors that go into it that it's hard to say, like, always, never. It's always somewhere in between where it's based on your specific scenario. If the seller's paying it, it ain't your money, right? So the 7,000 for 2 points, it's like, okay, may or may not matter because it's their money, but you might consider using that 7,000 to pay for closing costs instead of buying down the interest rate because you expect to sell the house, refinance, or be out of it within 3 years. It's always a fine balance too. And I talk through this type of stuff with clients on a daily basis and let them make the decision ultimately, like what makes more sense to them.
Yep, absolutely. It's based on your own scenario, really. In my opinion, if I'm going to be buying a house for long term, I'd rather save money right now, like thousands of dollars, rather than decreasing my housing payment by $25 a month, whatever.
Yeah, for sure. Today's dollars are always more valuable than dollars 5 years in the future.
Absolutely. All right. So a question, I have a home worth around, and we're going to wrap this up. I have a few questions here I just highlighted here. So I have a home worth of $550,000, a rate at 3.25%, and about $130,000 in equity. Would selling now and buying a new home, because we want to move to a new state, be an okay to sell and buy? And so I would say if you're going to be buying a house for the same price, $550,000 or more, your new rates can be around 6%-ish. And so therefore your housing payment would absolutely skyrocket. And if you're going to sell your house at $550,000, buy the same house for $550,000, assuming the same property taxes and insurance, your housing payment would absolutely skyrocket, and it may not make sense, but it just depends on what you're looking to do. If you're selling your house at $550,000 and you're going to be buying a house at $250,000, your house payment goes down, even though mortgage rates have gone up, and you'd rather live in another state, you hate your house, your neighborhood, whatever, then of course it might make sense. So it just depends on your scenario. Anything you want to add regarding that?
Yeah, I mean, to your point, if it was just should I sell now and buy, rate's going to be higher, and it might not sound a lot to go from 3.25 to 6, but when you attach a $400,000 or $500,000 mortgage to that, and you realize it's $1,000 more per month, that's a big deal. So if it's a lifestyle thing, like you said, you hate your neighborhood, you hate your state government, you hate the tax rate, we've got different reasons for people leaving different states. I'll leave the politics for other channels. But yeah, that might be the motivator. And in those cases too, like people have motivations that outweigh the financial stuff, where it's like, you know what, I'm going to make it work. But ideally you sell, you take some of that equity, you put a down payment on a cheaper house in a place where you're really stoked about living.
This is why we're seeing a lack of new listings, right? Some people, okay, well, I have this house, I want a bigger house, nicer neighborhood, it's gonna be more expensive, but you look at the payment, if you're gonna be basically buying your house, the same payment, or same house, then the same price, I should say, then your payment would absolutely skyrocket because rates have gone up so much. Matt says, yeah, put some offers in already. Awesome. Hope you get a offer accepted soon, Matt. Best of luck to you on that. Absolutely. Do you believe that home values will shift by November? We're already seeing home values or home prices, or at least the median sold price, go down, not by a whole lot, but it is going down on a national level. I would say it varies by the area you're talking about. So if you're talking about, I don't know, Boise, Idaho, where 70% of all the active listings have had price reductions, and we're seeing new listings absolutely skyrocket. It's crazy. So yeah, it just depends on the area you're talking about here. Regarding this, let's see, question, leaving California to Raleigh, North Carolina. I made a video about Raleigh, so check that out if you didn't see that. 725 FICO, $80,000 cash down. When should I buy two? I don't know. I have a Wells Fargo approved. Who should I go to get a mortgage with if Wells sucks? I don't know. When should I buy two? I'm not sure what he means, but
I think it was like number one, when should I buy? Number two,
oh, sorry.
Wells.
Yeah. Right.
The only thing he's got to change is if to since Wells sucks. Sorry, my attempt at a joke there. I would suggest talking to a local
this video is
broker.
Not sponsored by Wells Fargo.
Definitely not sponsored by Wells Fargo. Yeah, talk to a local mortgage broker. I mean, when should I buy? That's anyone's guess, right? I think that
personal choice.
To Jason's point, yeah, it's like things are market specific. Where the hottest, the Boise, Idaho's, the Phoenixes, the Texas, the Floridas that saw the biggest booms are seeing the fastest shifts. So yeah, I mean, your timing is probably going to depend on your lifestyle and other things you got going on. But yeah, get yourself pre-approved with the mortgage broker. It can't hurt, right? And yeah, I won't pound Wells Fargo too bad.
Okay. All right. So crystal ball. Oh, someone's talking about crystal ball. This is trouble. Devin, question. I know your crystal ball broke a long time ago. That's definitely true. I am not a real estate market fortune teller. But Jason, realistically, will you see high 3s, low 4 mortgage rates again? Well, ask Fannie Mae, because they believe that we're going to see rates in the 4s next year.
Yeah, Fannie Mae says 4.7 in Q1 and 4.4 by Q3. They're out of their mind. I wouldn't be super surprised to see 4s the end of next year. When you talk about seeing high 3s, you might never see high 3s. I'm not saying it's impossible, but for people, a lot of people are just a little bit of hopium where it's like, oh yeah, when the rates get to 3.5, that's when I'm going to do this. What if the rates don't ever get to 3.5?
Right. I'll just buy now at 6% because I can just refi in a year at 3%. It's like, good luck.
Yeah, if someone's telling you that, they got a bridge to sell you too. Yeah, I would agree with Matt. I mean, seeing rates in the 3s would be hard to come by. That'd be
drastically different what we're seeing right now in the fours. Potentially, it just depends on what's going to happen with the inflation, in my opinion. And also,
if the economy, goes in the tank and the Fed has to do some sort of pivot, sometime next year, then maybe we see some rates come down.
All right. So another question here. Do you expect Sacramento builders to take big losses who got new houses built or going to build in the next few months? So one thing that we really don't know is that if you guys follow the channel and you maybe follow other channels, you hear that we have like a record number of houses being built right now. What we do not know is how many of those houses under construction are already under contract with a home buyer. And so it's really hard to understand. Okay, well, if we have a record number of houses under construction, that's due to like, builders have been ramping up construction, but also we've been seeing a high amount of demand, and a lot of home buyers put deposits down and signed in contract when the house was a dirt lot. Now it's under construction. Now, because all these delays and getting materials and also these other headwinds that builders are facing right now with labor and such, it's taking longer for houses to be built, and therefore that total number of houses under construction is very much elevated. So what we don't know is how many of those houses are still under contract with the home buyer. So we really don't know what that is, and so we're going to have to see how this all plays out. But I think that I don't know about big losses. I know like their gross profits are still pretty high, but I would imagine that we'll see more and more news being reported that builders are giving more buyers more incentives, whether it's like, a dollar amount for free upgrades or to lock in their mortgage rate earlier. So, big losses is anyone's guess, but I think we're going to be seeing more and more headwinds in the new home industry here. And this is due to a huge pullout in buyer demand, as you guys probably saw in my videos regarding new home sales as of recent. Anything you want to add regarding that, Matt?
Not necessarily, except for that, like, builders are relatively smart, and so they have a little bit of control on the throttle, right? They're going to stop building as fast as they've been building. They already have, and so they're not going to have a glut of inventory. The stuff that they have that's complete, and if it hasn't sold yet, which most of it has, they're going to say, we'll give you $15,000 in credit. Use our in-house lender. We're going to give you 30,000 upgrades on the house. And they're going to sell that stuff, and it's going to be gone. And they're going to strategically build according to the demand that they see in the future, so that there's not going to be any point where they're going to have to fire sale stuff. Like, builders are smarter than they've ever been. They're for-profit businesses, and they have experts that know what they're doing. And so the numbers point to the fact that builders understand the demand has slowed down, so they'll start slowing down their building, so there's never this humongous supply versus demand inequality is going to cause them to have to slash prices by a lot.
I think it depends on how many people are actually still under contract with their builder, because the Census Bureau records a sale as when a sales agreement's signed between the buyer and the home builder, but they don't go back and say, hey, is that 1 month later go, hey, do you still have that buyer in a contract? They don't do that. So they just report contracts being signed each and every month, compare that to prior years and prior months. But we don't know is how many of those actually fall out of escrow. But you make a really good point here regarding that builders are pivoting. And so if you guys missed my video, I posted a few days ago regarding new home construction numbers. And I've been reporting to these guys for several months now, but builders right now are more focused on building multifamily properties and not so much single family, because of this huge pullback in demand due to rising mortgage rates. So take a look at that video if you guys haven't done so already. And with that said, thank you, Matt, for joining me in today's video, and everyone for joining here as well. I really appreciate you guys' time. If you guys haven't checked out Matt's channel already, Matt the Mortgage Guy, take a look at his channel. A lot of good information and insight you provide. So anything you want to say, Matt?
Not much. I appreciate you having me. It's always good chatting with you, and it's fun to be on here. As we alluded to earlier, the market is changing every single day. There's a lot of stuff going on with rates, with the market, with inventory, with builders, all kinds of stuff. So let's continue the conversation on another day and continue to do what we can to bring good information to folks so they can be empowered to make good decisions when it comes to real estate.
Absolutely. I mean, that's like we have the similar goals on our channel, just basically educate people so they can make more informed decisions, really, rather than like pushing a narrative and just basically sharing the latest housing market trends just like you're doing. So I appreciate you, everyone who is watching this video. I really appreciate you for joining us today. Please browse the channel and subscribe, and have an awesome